What do you think?
Hello, everybody. Good afternoon. Before I forget, next week we will start long-term liabilities. For this topic, we need your financial calculators. We need specific calculators for calculators and value. We will make a lot of present value calculation. What is present value calculation? If I'm going to receive $100,000 within 1 year, how will it work today? Or if someone asks you, for example, let's say you prefer I give you $100,000 within 10 years, or $5,000 every year from now for 1 year. For example, for this kind of situation, we will need to make present value calculation, which is what does $100,000 in 2 years is worth today? What does it worth today? That is present value calculation. For this, you need specific calculators, financial calculators. Okay? Financial calculators are available for you on the management department. Go to the office of the admin who is there, Noha. You have to go during her, because she has 2 days of teleworking. It is on the door office. You will see when exactly she's available. I think Wednesday to Friday. And then you can borrow a financial calculator, sign a form, and then you have to return it after exams. For sure, you need it for exam. So familiarize yourself from now when we use a financial calculator for your assignment, but especially also for your final exam, because you will need the financial calculator for your final exam. So the more you take time to familiarize yourself with it, the better it is for your final. So they are available. I'm sure that they are available waiting for you. Just go pick up a calculator, sign, and keep it for you until your final exam is done, and then return it when the final exam. And this will be needed starting next Thursday, because next Thursday we'll start to make present value calculation to give you long-term activities. Okay? But today, we're going to make the practice of what we covered Monday about PPE. First aspect of the PPE is to be able to determine what kind of expenditure is capitalizable as a PPE and what kind is expensive. For example, let's do only the exercise number M73 on page 415. For each of the following items, enter the correct letter, which means indicate if it is a capital expenditure, if it is an expense, or neither. Capital expenditure, it means something that should not be accounted for as an expense. It is a capital asset, capital item. Purchase a patent for $300. Is that a capital expenditure or an expense, or neither? Patent, what the patent is an intangible asset, right? Right? So when you pay for the $3,000 to purchase a patent, what kind of expenditure is this? Capital expenditure. Second, pay $10,000 for monthly salaries. Is this capital? No, this is an expense. Very good. Monthly salary is an expense. Pay cash dividend, $20,000. The answer here is neither. It is neither capital asset nor expense. So we have one option is neither. And what is this? It is a financial expenditure. So neither capital expenditure nor expense. And then number 4, purchase the machine for $7,000. Sign it as a long-term note. Is this a capital expenditure or an expense? Machine. So expense is something consumed during that period, during the counting period. Consume it and that's it, it disappeared. We consume it. Expense, like paying gas for your car. Compared to buying a car. See the difference? Capital is something that will remain. It's something that will remain and will generate and contribute to generate revenue over years. That is the capital expenditure. So if you pay $7,000 for a machine, it is not like paying for the oil change of my car. It is like buying a car, right? It's capital, right? Because the machine will be used over many years. So capital. Now next, number 5, pay premium for a 1-year insurance policy. This is expense, obviously. And then pay for routine maintenance, $200. Like oil change for your car. Routine maintenance. So, expense, not a capital. Expenditure. And pay $400 for ordinary repairs. Exactly. Ordinary repairs. So it means I just make the repair to continue to use the PPE as is. But sometimes we fall on the gray area. Sometimes we fall on the gray area, especially when the amount is significant. Now maybe 400 is not significant. If it was 40,000 for a building that is worth, let's say, $400,000, paying $40,000 for repairs, for maintenance, is that really capital or not capital? Here we ask ourselves this question: after these repairs, are we going to continue using the PPE as is, as it was supposed to be used, or is there going to be an improvement, enhancement of the capacity of production? If there is an increase of the capacity of the production, then it will be capitalized. If it is, we just painted the building just to continue using it as is, then that is an expense, no matter what the amount is, no matter how significant is the amount. And then number 8, paid $6,000 for improvements that lengthen the asset productive life. What do you think about this? $6,000 for improvement to the asset, and that improvement, as a consequence, it will lengthen the asset productive life. So it means, and instead of having a remaining useful life of 3 years, with that expenditure now we move to go to 5 years of use. So this is capital. Yeah, no. This is capital expenditure. And then the last one, pay $20,000 cash for addition to annual building. Capital. Exactly. So this is the first aspect. Now, exercise 8.4. Sorry, 7. It should be 7. Chapter 7, because there was a change of the order of chapters last year. That's why. Seven, 4. Exercise 7.4. Page. Where is it? I don't have the page. So, compute and record the costs and depreciation. So this company bought a building and the land on which the building is located. Okay? Now, total cash, total price of $356,000. What is the challenge here? A single purchase, a single acquisition, single contract, and a single amount. $356,000, this is what we pay for the building. Okay? From legal perspective, single contract. From accountant perspective, we did not buy a building. We bought two items, two different capital assets. We bought the building and the land on which the building is built. So these cannot be counted together in a single transaction, single account. The building has a useful life. The land has an infinite useful life. So this is the challenge we have. Now we have just one single amount, $356,000. When it comes to making the journal entry, if we try to make the journal entry for this, we are going to credit cash $356,000. However, we don't have one single item to debit. We have two: building and land. Two items. Why? Two, because this has an infinite useful life, and this is subject to depreciation, has a limited useful life. They cannot be mixed together from a accounting perspective, even though they were mixed together from legal perspective in the contract. The challenge now, how to split this amount between the land and the building. So this is the issue. First issue with that. And there is a technique we are going to learn how to do that. So they say the company paid transfer cost of $4,000. So add to that $4,000. Is it capitalizable? Is the $4,000 expense or capital asset? $4,000 we paid as transfer cost. To make the ownership transfer, we need to pay this for the lawyer and for the transaction. So is the $4,000 expense?
Isn't it an expense?
It is not an expense. It should be added to the cost because, as we said, the rule is any expenditure needed to bring the PPE to the location, the state where you can use it, is capitalizable, which means should be added to the cost. So now the total cost is actually $360,000. The purchase price plus the transfer cost, because that is part of the cost. Both have to be split between land and building. So now, and also there are renovation costs of the building were $46,000 again. But the renovation cost is easy. So the renovation, clearly it will be added to the building, right? The $46,000, that is a renovation of the building. It has nothing to do with the land. So this is not an amount that needs to be split. It has to be allocated 100% to the building. Now, this $360,000, how are we going to allocate it? Now, this is how you should do. You should proceed. Ask for an independent appraisal, expertise, real estate expertise, to make separately two assessments: the assessment of the building and the assessment of the land. No matter how much you pay for it, ask for an expert, a real estate expert, and make an independent appraisal where they will make an estimate. They will provide you with an expert estimate of what is the value of the land and what is the value of the building. This expert, they don't know how much you pay for it, and no matter how much you pay for it, you don't tell them this information. This is secret, confidential, keep it for you. And ask the expert, what is your appraisal to the land and what is your appraisal to the building? And surprisingly, the total amount of both will not be what you paid for. It could be higher, it could be lower, because what you paid for was the result of negotiation, was a result of we start with the price and we negotiate, not a result of market, while the appraisal is based on market value, right? So how are we going to manage this situation? So this is how it is going to be managed. According to the expert, they say an independent appraiser provided market value for the land, $100,000, and the building, $300,000. So according to the expert, the real estate expert, the building is worth $300,000 and the land $100,000. Right? So a total of $400,000. We did not pay $400,000. We paid $160,000. Now, this is how it is going to work. We are going to calculate the percentage of each item on that total. We have the total value is $400,000. On that $400,000, what is the percentage, the ratio of each item? For the building, it will be 300,000 divided by 400,000, 75%. And for the land, it will be 100,000 divided by 400,000, 25%. And then use those percentage, apply them to what you have paid, to the real cost, the actual cost you paid. You have paid 360, 75% of that 360 goes to the building, and 25% goes to the land. So the total amount that was paid, the total cost is $360,000 as a lump sum. We call this lump sum acquisition. And then you simply multiply the lump sum amount you paid for by the percentage of the building, so that you get the accounting value, the book value of the building. And same thing, you multiply the lump sum by the percentage allocated to the land. So and this is your 360,000, and that's what you need to make your land. Okay. So debit land $270,000 and debit building $90,000, so that you make the split of the work. So and the total cost of the building. So you have the appraisal cost, 270, plus that addition. The addition, they say, or the renovation. They say there was a renovation of $46,000. The $46,000 was a renovation for the building only, because you don't have to split it between the building and the land. Dedicate it completely to the building. So just add it to the building. Do I have it here? Is it 46? Yeah. That's it. So now that you have the amounts, you can now account for your journal entry for the acquisition. So appropriate, and then prepare journal entry to record the purchase. So building, land, debit, credit, cash. Presuming that you paid it cash, right? Building 316, land as per our calculation 90,000, and cash for the total. This is the first question, and then the next question prepared, so the answer that compute the depreciation. Okay. The depreciation of the building at the end of the year. The reason we split the amount into two items is because the land is not subject to depreciation, while the building is subject to depreciation. So we have to calculate and account for the depreciation, compute the depreciation of the end of the year using the straight line method. assume that an estimated useful life of 12 years and an estimated residual value of $28,000. Okay, so the cost for the building, as we agreed, it was $316,000. Useful life 12 years, residual value $28,000. To calculate depreciation, first of all, we need the depreciable amount. The depreciable amount, which is the amount subject to depreciation, is always equal to the cost minus the residual value. Before we move forward, what is the residual value? Remember what the residual value is? The residual value. Cost, you know the cost. How much was the cost? What about the residual value? What do we mean by residual value? What is the residual value?
Is like it's an estimated value of what something's going to be after it's done with its like service life, like after it's used.
Exactly. That's exactly the definition. It is an estimate of what would be the fair value of the building at the end of its useful life. After we cover the full period of its useful life, in this case 12 years, after 12 years of use, how much is it going to be? It's expected to work at that time. And for depreciation, for the purpose of calculate depreciation, you always consider that residual value. It has always to be subtracted from the cost, so that you depreciate the remaining the depreciable amount is the cost minus the residual value. So cost, which is 316,000, minus the residual value 28,000. So that is the depreciable amount, and you have to split that amount over the period of 12 years because we use straight line, which means same amount every year, unless the purchase happened on the middle of the year. I presume the purchase happened the full year, divided by 12 years. So every year, every year we are going to account for $24,000 of depreciation every year. So debit the depreciation expense, credit accumulated depreciation, as you know, depreciation expense on the debit side, and then credit accumulated depreciation building for the amount we have just calculated. Okay, next, we are required to show how all of this is going to be presented. What would be the carrying amount of the PPE on the balance sheet at the end of year 2? What would be the carrying? So at the end of year 2, how is all of this is going to be presented? So non-current asset, non-current asset, PPE, land, and then you present the cost of your land as we have calculated it here. Where is it? As per the journal entry, $90,000. And then building, so cost minus the accumulated depreciation. Cost, you have to show the cost the cost of the building, the historical cost, which is $316,000, minus the accumulated depreciation. In year 2, after 2 years of depreciation, the accumulated depreciation will be 2 times the $24,000. Okay, minus $24,000 times 2, $48,000. Okay. And you get the net amount of the building. Carrying amount at the end of the year is the total. Okay, 385. Any question about this? So what we this exercise, what we learned from this exercise, first of all, how to account for a lump sum payment when we also call it basket purchase. Basket purchase, when you pay a single amount for several items together. How to split that amount into to allocate the amount to every or each one of the items in question. In this case, it was building and land. It could be a manufacturing unit where you have many items, equipment, building, land. And the way you do it, ask for a price for every specific item separately, calculate the percentage for every item in the total, and then allocate that percentage to the lump sum that was paid, so that you get the dollar amount of every item separately. And we also practiced some depreciation, simple case of depreciation, and also presentation on the financial statement. Now we're going to now to practice the three method of depreciation: straight line, double decline, and unit of production. First case, so this is exercise 8. Exercise 8, where you have information about the PPE, and then the question was complete the separate depreciation schedule, assume that one of the three methods: straight line, unit of production, double decline. So the information we have, the cost is $10,000. This is a PPE that has $10,000 as a total cost. Useful life is 4 years. Residual value $1,000. First, let's assume we use the straight line method. Assuming the straight line method is used, what is the depreciable amount? The depreciable amount is what? We said cost. Cost minus residual value. Good. 9,000. Depreciable amount. That is the depreciable amount. Cost 10,000 minus residual value. Okay. And then that depreciable amount is what you are going to use to make your depreciation for every year. For year one, so let me check if the purchase happened from the beginning of the year or in the middle of the year. So they say it's company at the beginning of the year. It makes difference, right? It depends. So beginning of the year, which means the first year is complete, 12 months of depreciation. So how to calculate the depreciation? Straight line. Do we have the number of, so useful life is for 4 years. We can calculate the depreciation rate. Not necessary, not mandatory, however it helps. When you convert the number of years into percentage, it makes the calculation simple. Just multiply by a percentage instead of dividing. Always multiplying is always easier than dividing, right? So let's convert the useful life into percentage. If it has a 4 years useful life, then the depreciation rate would be 1 divided by 4 years, which means it is going to lose 25% of each value every year, after every year of use. So the depreciation is 25%. Okay? Then we simply multiply the depreciable amount, 9,000, by that rate. And this will be the case every year. Also, same thing. As we do depreciation, we are accumulating depreciation. So the first year, the accumulated depreciation was this. I only have 1 year of depreciation, so the accumulated depreciation so far is 2250. Next year, the accumulated depreciation is the depreciation of last year, or that accumulated last year, plus what has been added this year, a total accumulated depreciation at the end of year 2, this plus this, $4,500. I have to keep also track of the carrying value. How do we calculate the carrying value? There is a very common mistake here. I need you to pay careful attention. How to calculate the carrying value? Depreciable amount. So that is exactly this is what most students will do, which is not accurate. The trap here is when you calculate the carrying value, you use the depreciable amount minus the accumulated. That is wrong. You have to use the cost. Carrying value is always cost minus. This is a very common mistake. Many will do it, which is not correct. Carrying value is not 9,000 minus accumulated. No, cost. Go back to the cost minus accumulated depreciation. The cost is, in this case, 10,000, okay, minus the accumulated depreciation so far, okay. And same thing here, always get back to the cost. Cost minus accumulated depreciation, and then we keep doing this. See, just make sure to get absolute address instead of relative address. We keep doing this until the end of the useful life. After 4 years of depreciation, we accumulate the depreciation, and look at this. You always have to end with the residual value. The last cell should correspond to your residual value. The $1,000 is simply the residual value. If you don't end with the residual value in your amortization schedule, there's something wrong. No matter what method you use, whether it is straight line, whether it is the variable method, unit of production, or the double decline, you should always end with the last year, the very last carrying value should always be the residual value. And so that is a general rule that does not depend on the approach. To make the calculation for year one, so the general entry for year one, as you know, depreciation expense, debit, credit, accumulated depreciation, and then you make sure to specify what is this exactly. Accumulated depreciation, is it what is this? Equipment, vehicle, what is it? Number 8, machine, equipment, right? Cream maker, so equipment. First year, you pick up the depreciation expense of the first year. Next, with the same data, now assume the unit of production method is used. Unit straight line presumes that we use the equipment or the PPE in question in a consistent way from year to year. The only variable is time. As the time goes, the depreciation increases. No matter how are you abusing or using the rate at which you use the equipment for the PPE. That is the straight line. Variable, it will depend on how you use and the rate to which you use your PPE. So in this case, we are going to we need an estimate of the productive life. So they say, assuming that the unit of production method is used, and they expect, according to the manufacturer, over the useful life of the equipment, it is going to run 9,000 hours. That is the total expected unit of production, 9,000 hours. So we have to calculate, first of all, the depreciable amount. Depreciable amount under the unit of production is exactly similar like in the straight line, which means cost minus residual value. So same thing like the straight line. Depreciable amount is cost minus residual value. Cost 10,000 minus $1,000 of residual value. That is the amount we are going to make to depreciate.
and we need the depreciation expense per hour. So we are, the total cost is $9,000, and this machine or equipment is supposed to run 9,000 hours. So we have to calculate what is the depreciation expense per hour for every hour. So it would be $9,000 divided by 9,000 hours. That is $1 per hour. Every hour the machine will run, it will lose $1 of its value as a matter of depreciation. So if now we have the actual number of hours, the actual number of hours is year one, the equipment has run 3,600 hours, year two 2,700 hours, and year three, and so on. Okay? How then we calculate the depreciation for every year? For year one, for example, after 36 hours of use, how much is the depreciation expense for that year? 36 hours times $1 per hour. Okay? So depreciation expense is 36 hours multiplied by what we have calculated as depreciation per unit. So, accumulated depreciation, that is the only depreciation have, and the carrying value, again, always calculate the carrying value as the cost minus the accumulated depreciation. The cost minus the accumulated depreciation. And we keep doing this every year until the end. And again, something is wrong here. 9,000. Second year, 27,000. So $27,100,000. And the depreciation, of course, accumulated is this plus this. Okay, that is the accumulated. And now, if we keep doing this, multiply the actual number of hours per the depreciation per hour, and then calculate to update your accumulated depreciation. And your carrying value is always the cost minus the accumulated depreciation. At the end of the day, whatever the method you use, you have to end with the residual value. Yeah.
In the last table, was the year one depreciation expense given? Was that good?
Calculated. We have calculated it. The first table. So, okay, let's do it again. Okay, so here, depreciable amount multiplied by the depreciation ratio, or the depreciation percentage, which is the depreciable amount 9,000 multiplied by depreciation rate 25%. Okay. That is the straight line method. The other way you do it, if you are not comfortable with percentage, or you can, it is percentage will make it easy and more beautiful to look at, if you like, but it was not given. The other thing you do, if you need to simply the depreciable amount divided by the number of years, as simple as this. 4,000 divided by 4. Usually we convert the depreciable, the useful life into percentage, because it is always easier to multiply. So while with the same data, here we end with $36,000, $3,600 of depreciation, because this is the variable, this is the unit of production. There was 36 units of production during that period, and we have already calculated the rate per unit, $1. So that's how we get the $3,600. How about if the original active cost similar? So depreciation expense debit and credit accumulated depreciation equipment. Year 3, so I have to jump to year 3. The depreciation expense for year 3 was $1,800. Okay? The double decline now. The most challenging method for student is this, so please, your careful attention. It is a little bit complex, but if you give me your careful attention, you will understand it. The double decline. In real life, Canadian companies use this method, especially for trucks. Particularly, this is a common practice. Whenever a company purchases a new truck, while the truck is new, doesn't need repairs, it has full capacity, they abuse that truck in first years. The reason abuse means they would use it 20 hours a day at the beginning, because it doesn't require repairs. It is new. Brand new truck, 0 kilometers started, then they would abuse it. And then when it starts to consume repairs, and when it starts to fall into repairs, then they will decrease the use. So this phenomenon makes an increase or a substantial use of the PPE of the first years, and then progressively decrease of the use. So we need a pattern, a method that reflects that economic patterns. This method is the double decline method. How does it work? It works like this. First of all, whether on the straight line or on the unit of production, remember that we have subtracted the residual value from the cost to make the calculation. Here, under this method, the depreciable amount is not cost minus residual value. The depreciable amount is the carrying value itself. The carrying value, and you know the carrying value is a moving amount, not fixed amount, right? If you look at the two other methods, in this method, the straight line, the depreciable amount is 9,000. It never changes. It's always the same. Carrying value will decrease. You see? Same thing. Unit of production, depreciable amount is the same. We have used always $9,000 as depreciable amount. The carrying value is a moving value. It is not a fixed value. It will decrease. Under the double decline method, your depreciation basis, your depreciable amount is the carrying value. That moving amount is your depreciable amount, which means it changes every year, and it decreases. To be more specific, it decreases from year to year. So residual value is not subtracted from the cost. Residual value is not ignored. It will be considered at the end. You will see at the end of the table, the schedule, we will consider the residual value. Depreciable amount equal to carrying value multiplied by the depreciation rate, and the depreciation rate is double of the equivalent straight line rate. That is what we call. That's why we call it double decline. First of all, the rate you use is double of two times the equivalent straight line rate. If it is a 10-year useful life, what would be the double decline rate? For a 10-year useful life, what would be the double decline depreciation rate? Two times the straight line rate, if it is 10 years. So the straight line rate is 10%, right? Then 2 times of that, so 20%. Okay. So if the useful life is 5 years, what would be the double decline rate? 40%, exactly. If it is 25 years useful life, what would be the double decline rate? 8%. Okay, that's it. Okay, 2 times the equivalent straight line. So the the double decline rate, because the useful life here is, we said 4 years, right? Useful life is 4 years. And we have already calculated the regular straight line rate, and we found it is 25%, right? Just make it multiply it by 2 times that rate. So, which is 2 multiplied by 1 out of 4, if you like, 50%. Okay, so that is the rate we use. Multiply that by what? By the carrying value, not the depreciable amount. The depreciable amount is the carrying value. What would be the carrying value on what? So what would be the depreciation expense of year 1, which means carrying value at the beginning multiplied by 50%. What is the carrying value now? Year 1. How much is the carrying value year 1? Remember, what is the carrying value? Cost minus accumulated depreciation. We are in year 1. We have not yet accumulated any depreciation, right? Accumulated depreciation is 0. We just started. So it would be cost minus 0. So year 1, the carrying value is simply equal to the cost. Year 1, the carrying value is simply equal to the cost. Why? Because carrying value is cost minus accumulated depreciation. We have not yet accumulated any depreciation, so it would be cost minus 0. So carrying value in the first year is the cost itself. So look for your cost. Where is it? $10,000. Multiply it by the double decline rate, which is 50%. So depreciation expense for year 1 is $5,000. Now we start accumulating depreciation now. So this is the accumulated depreciation. And now we have a carrying value which is different than the cost, because now the carrying value is the cost minus accumulated depreciation. This is the cost. This is the cost. Minus accumulated depreciation, 5,000. So the carrying value now is 5,000. That updated carrying value will become the basis of calculation for the depreciation for the second year. Again, remember, the depreciable amount for every year is the carrying value from last year multiplied by, when you multiply it by the rate, you get the depreciation expense. So carrying value is, which is now 5,000, multiplied by the rate, which is 50%. So this is the depreciation. Look at compare the numbers. First year, $5,000 of depreciation, half of it. The next year, $2,500 only. You see the pattern of making a significant use the first years, and then progressively it will decrease significantly. So the accumulated depreciation, then after 1 year of depreciation, 1 more year is this plus this, and then carrying value, cost minus the accumulated. Year 3, the carrying value, which is now $2,500, multiplied by 50%, the double decline rate. And then we continue accumulating the depreciation. And then we calculate the carrying value. Okay, so is this clear so far? Any questions so far? And now the problem. The problem now is, if we continue that way, this is what will happen. If we continue exactly the same way, what will happen is, this will be the carrying value multiplied by 50%, the rate, okay? Accumulated depreciation is this plus this. And then if we calculate the carrying value, this is what we're going to find. 625. And now that is problematic. So 625 is below the residual value. And we say that the rule is you have to stop accumulating depreciation as soon as you reach the residual value. The carrying value should never be below the residual value. Okay, so how to fix this? What we have just done was just a first attempt. Okay, and then when the attempt ends with an amount which is lower than, so rejected. Okay, this is the first attempt for year. We have to do that attempt because we don't know, okay? Until we reach an amount which is lower than the carrying value, we have to keep doing the same thing, okay? Until when we have this situation, then we reject the attempt. We say no, we don't accept this, and then we make the real now year 4. And this is how it works. We are going to abandon the regular way we proceed, forget about the depreciable amount, and then ask yourself, because you have to end with $1,000 here, the residual value, for sure. You cannot depreciate more than the residual value. Let's fix, enforce the residual value here. And also the accumulated depreciation, the maximum accumulated depreciation I can accumulate is cost minus residual value. I cannot accept more than this. I cannot accumulate more than this. The maximum accumulated depreciation is the cost minus the residual value. And then I ask myself, what should be the X amount needed as a depreciation expense for year 4 in order to reach this? Now I am here. Remember, this was rejected, so ignore this. Now I am here. I have accumulated up to $8,750 of accumulated depreciation. The question is, how much depreciation should I add on the last year so that I reach the maximum, the cap? Simply the difference. And then we would say X is equal to the difference between the target. The target is a maximum accumulated depreciation of 5,000 minus the existing accumulated, so it should be 250. Last year we changed the rule and we calculate depreciation as what? The number, the amount needed to reach the maximum accumulated depreciation. How do we get the maximum accumulated depreciation? Cost minus residual value in such a way that the carrying value should never be lower than the carrying value, the residual value. Okay? Any question? So this is for students, they find this as the most complex technical aspect of this topic. The straight line is straight, it's forward. That means the other one, the unit of production, is also easy. This one, you have to pay careful attention to the way it works. If you have any question, please ask now. So again, to summarize before you go to the break. So first of all, the depreciable amount each time is the carrying value of last year multiplied by the double decline rate. We have already calculated double decline rate, which is the equivalent straight line rate multiplied by 2. And then carrying value the first year is simply equal to the cost, because the definition of carrying value is cost minus accumulated depreciation. There is no depreciation accumulated the first year, so accumulated depreciation is 0. Cost minus 0, that is the cost. Multiply it by the rate and you get the depreciation for the first year. That would be your accumulated depreciation. You calculate your carrying value, cost minus accumulated depreciation. That carrying value of last year becomes the basis of calculation of the expense for the second year. 5,000 last year carrying value multiplied by 50%. And I keep doing this And if mathematically, if you keep do this, it will never end. From mathematical perspective, if you continue to do this, you will never end. You will continue thousands and hundreds thousands of years, and will never get to zero at all, theoretically. But you have to stop it. Where you stop it? You stop it at the residual value. Keep doing this until you get to the residual value. When your carrying value becomes equal to the residual value, then you stop. This situation would make us at some point an attempt. We keep watching this. We keep watching this. As long as it is higher than the residual value, it's fine. It's fine. Continue. When it becomes lower, then I will reject that calculation, that first attempt of calculation that ended with a carrying value which is lower than this value, and then make another calculation where I decide what would be the maximum accumulated depreciation, and then ask myself how much is needed to reach that maximum. Look at your accumulated depreciation so far, and ask yourself how much is still needed to reach that accumulated depreciation. That will be your depreciation for the year on which you reach the maximum. Let's make a 10-minute break and come back to the complete math practice.
If I could do my first thing, sorry.
Your name is Ricky.
I got banned.
That was me with my slit. I like held my slit the entire time. Slit.
Feel bad?
Yeah.
He's only 18.
You leave, I will walk
I have cooked these. I'm telling you, this squad. I'm going straight to his office. The bagels? No, the bagels are gas.
Imagine you're I would genuinely probably die. He like goes and talks like I'm not even kidding. Yeah. He genuinely like he sees you.
Yeah.
You can't even be inside. Like literally you have to like put on all your stuff when people get supposed to go to the bathroom.
Dude, it's $4,000 to
She actually shot herself.
It was really good.
You just feel like
Don't jinx it.
fucking hate that shit.
It's like the two literally.
He's such a bitch. Like,
Hope is like
Either like super short and friendly.
so you don't like or have it loaded.
Oh my god! Exactly. How is that? This is
That's your. I do the same. I never started getting there. I kind of lost it.
You can always try it.
She's going. Yeah. Yeah. Hello? Oh, yeah. Pulling up on yeah.
I have
Why is it yellow now? Yeah, it's fucking.
Okay, well, you made it.
Yeah, what if we all Irish goodbye? What would you do?
Oh.
Richie. Okay, I said.
Don't we finally dropped it, bro?
What if I got one of them? But like, I'm only one
Yeah, you can spend it
This is pretty fun.
I don't know how they stick it. Yeah, it is. That's why that goes to
hard though.
because in this position, that includes share the square test. Oh, I don't know.
That's legendary, bro. That's actually horrible.
Because ours did say like it's
Have you ever done Aussie before?
okay, but this must be like a div thing.
Oh my god.
Yeah, I got one.
Oh.
Are you guys ready?
How about this, son? I don't know about that.
Yeah. Okay. This is actually the same.
Okay. So next. So now we practices.
Cost element, how to distinguish capital expenditure from expense, the three depreciation methods. And now, the next subtopic is how to account for disposal. disposal of PPE. PPE is not supposed to be disposal, it's not supposed to be swallowed, not like inventory. However, for many reasons, we were intending to keep our computers for 4 years, and suddenly we discover, let's say, a cybersecurity threat or a problem, so that forces us to sell the existing computers and buy new ones. So you may be, for some reason, obliged to sell a PPE item. Then how to count for it? This is the process. First of all, the sale, that sale would happen at a random date during the year, right? July, March, April, October, at a random date. While the depreciation is just accounted at the closing day of every year, which means the carrying value is updated just once a year, right? So before you account for the sale, update the carrying value. Account for the depreciation between the last closing day until the day of sale, that period of 8 months or 7 months or 3 months. When you do that, even though usually depreciation journal entry is an adjusted entry, we usually do it at the end of the year only, but especially for disposal, we make an exception to this rule, and we calculate and account for the depreciation from the last closing day until the day of depreciation. Then, once your carrying value is updated, then you calculate mathematically the gain or loss on sale. The gain or loss on sale, calculated mathematically, is the selling price, the proceeds from the sale, minus the carrying value at the day of the sale. I have sold something that has a carrying value of $12,000. I sold it for $10,000. So there is a loss of 10,000 or 2,000, right? Selling price 10,000 minus carrying value of the day of the sale, 12. That is a loss. I sold it for 15,000. Then there is a gain of 3,000. $15,000 minus. You see? And then when you make your journal entry for the sale, you have to find with the counting approach exactly the same amount to calculate it with mathematical approach. That's where you can make sure your sale is accounted for appropriately. So, the example we have here, it is again 7, 8. Actually, it is the same data of here, the same data we were using here, but now we introduce a sale transaction, okay? So this is the same data, which is the purchase was January 1st of year 1, the cost 10,000, residual value 1,000, the straight line depreciation. I'm going to copy what was we did already, depreciable amount. So we said this minus this quickly, and depreciation expense. Let us just copy it as is from here. This is the same. Disposal. Okay. Depreciation expense. Accumulated depreciation for that amount year 1. Okay. And then where is the disposal information? They say assume that the disposal happened on July 1st, year 3. Year 3. So at year 3, at the end of year 2, we have accumulated already for $4,500 accumulated depreciation. In the meantime, before we finish year 3, on July 1st, at the middle of year 3, the item in question was sold. And it was sold cash for $3,000. So first step is to calculate and account for the complementary depreciation between the end of year 2 until the day of the sale. December 31st, year 2, or January 1st, year 3, until the day of the sale, which is July 1st. So that 6 months of depreciation have to be
times, which means a full year of depreciation for year 3 multiplied by 6 out of 12. Half year of depreciation, and we account for it. Depreciation expense debit, credit, accumulated depreciation for that amount. By doing this, we have just updated our carrying value until the day of the sale. Second, make a mathematical calculation of the gain or loss on disposal. Mathematical calculation of the gain or loss on disposal. We subtract the carrying value at the day of disposal from the selling price. So, selling price $3,000. What was the carrying value at the day of the disposal? Cost minus the cost, which is $10,000, minus the accumulated depreciation, including the one we have just added. The accumulated depreciation is the accumulated until year 2. We have accumulated $4,500 of depreciation year 2, plus the depreciation we have just accounted for, the very last one, the complementary depreciation. So the carrying value now is cost minus accumulated depreciation. So we have sold for $3,000 something which has this value, $43,000. So this is a sale with a loss, right? Again, if you need to calculate the accumulated depreciation, so year 1, it was this amount, and year 2, we added the depreciation for year 2, and year 3, the depreciation for the partial year depreciation. So the accumulated depreciation at the day of the sale was this, which is the same we calculated here. So the gain, the disposal gain or loss is $3,000, the selling price, minus the carrying value at the day of the disposal, which is $43,000. Because it is negative, then it was sold for a loss. Makes sense? We just collected $3,000 and we gave something which is worth $4,000. So there was a loss of $1,375. Now we make the journal entry to account for the loss. How to generalize the loss? How to generalize this disposal? Okay, the disposal. We don't know from accounting perspective whether it will end with a loss or a gain. From accounting perspective, we will check. So what we did is a mathematical calculation, and independent accounting process should lead to exactly the same amount of the gain or loss. So first of all, okay, there was a cash amount collected, so debit cash. The easiest part of the story is this: we have collected cash, $3,000. Next, what should we do? There was a sale of the equipment. So to account for the sale of equipment, which means exit of the equipment from our balance sheet, should be debit or credited? Equipment is an asset. You need to exit it from your asset, remove it from your asset. You have to then debit or credit the asset to remove it. It has a debit balance. We need to remove it, credit. So we credit the equipment for its cost. We remove it for its cost, which is, again, where is the cost? $10,000. And then that asset, if you look at here for the first one like we did, as you can see, for example, that asset, it comes on two lines. One of them is the asset itself, and then the accumulated depreciation at another item related to that asset. So if we remove the asset, we also have to remove the accumulated depreciation related to that asset. And then because it is a contra asset account that usually has a credit balance, to remove it, I have to debit it. So accumulated depreciation of the equipment for the total amount of the accumulated depreciation. We have already done our T account for it. And then that's it. The balance of this journal entry is your gain or loss on disposal. The balance I have total debit of 8,625 and a credit of 10,000. In order for this journal entry to balance, I have to add something on the debit side. If it is on the debit side, that means it is a loss. If it was on the credit side, it would be a gain. In this case, I need to add an amount on the debit side, and that amount is the difference, this minus this minus this. And because it is on the debit side, it is a loss on disposal. So from accounting perspective, I end with a loss of 1375. I have to check it with my mathematical calculation. And as you can see, when we calculated mathematically, we ended with exactly the same thing, which means I'm fine, I'm okay, it is done, and it was good, okay? So now, if it was an exam, and if you don't find the same thing, if it was an exam, you make your mathematical calculation, you find an amount, you make your journal entry, you found a different amount, and you don't make any comment, it means you don't know what you are doing. While if you don't find the same amount, because you don't have time, you know you are wrong, but you don't have time to fix it, add a comment. Write a comment to the marker saying that I know it should be consistent with the mathematical calculation. For lack of time or mathematical mistake, I don't come to the same amount. Show to the marker that you know what you need to do, and you know that you understand what should be, and the fact that you don't find the same amount was just a matter of mathematical mistake, and you are not assessed for your mathematical skills, you are assessed for your accounting skills. So if mathematics do not help you, so add a narrative text explaining what you expect. Now if we do exactly the same thing, but this time with a gain, not a loss, okay? Same data, same, everything is same, but we have sold it for 6,000, not for 3,000. Now, look at how the mathematical calculation will match the accounting approach. From mathematical perspective, I need to first calculate the carrying value. Carrying value is the same. It doesn't depend on the selling price. Carrying value is cost minus accumulated depreciation, and accumulated depreciation is calculated here. So carrying value is this minus this, same. But this time we have a gain on disposal. Why? Because we sold for $6,000, this is the selling price, something which is worth in books $4,300. So there is a positive amount of $1,625. Now, when I do the journal entry, I normally have to end with the same result. This result is not an accounting calculation, it's a mathematical calculation. This is the journal entry. And again, to make the journal entry, I keep the gain or loss at the end, at the last step. So I first start with the cash. We have collected $6,000 of cash. And then account for the removal of the equipment at its cost, which is $10,000. Remove the accumulated depreciation on the debit side at the accumulated depreciation amount, and then ask yourself, for this journal entry to balance, should I add something to the debit side or to the credit side? I have 11,000 on the debit side, 10,000 on the credit side. In order for this to balance, I have to add something on the credit side, right? And that amount that need to be added on the credit side is simply the difference between the debit amounts, this plus this, minus the 10,000. And because it should be on the credit side, then for sure any credit, any gain or loss on the credit side means it is a gain on disposal. So this is the gain on disposal calculated from accounting perspective. The amount needed to balance a journal entry. This is not mathematics, this is accounting, debit credit. And then check it with the mathematical calculation, and if it matches, that's fine. That's good, means so very likely it is correct. This matches the mathematical computation above, right? Now, let's finish with this problem. Again, from your textbook. Which one? I don't have the number of the problem, but this is the data. So we have this company, Bombardier, and data for specific machine, the cost of the machine, useful life 13 years, residual value $2,000. So if you use the unit of production, then the useful life in unit of production is 20,000 units. It could be hours, it could be kilometers, it could be meters, any unit of production, no matter. It could be simply units. And then the actual number of units produced year 1 is 20,000. Actual number of units produced year 2 is 16,000. And these are added data, not in the textbook. And clearly the practice would be about the accounting, the depreciation method. So first of all, presume a straight line depreciation method and prepare the full depreciation schedule. So at the acquisition, so carrying amount was $106,000. Cost minus accumulated depreciation. Accumulated depreciation is 0, so the carrying amount is $106,000. Year 1, so depreciable amount is the cost minus residual value. Cost 106,000 minus residual value divided by 13 years. So that is $8,000. And because the first year is a complete year, it would be $8,000 every year until you end the 13 years. Accumulated depreciation, 8,000 first time, and then 8 plus 8, and so on. And you keep accumulated depreciation. Carrying value always, again, cost minus accumulated depreciation, not the depreciable amount. Cost minus accumulated depreciation. And when you keep updating your carrying value, in all cases you have to end with the residual value at the end of the day. You keep decreasing until you get 2,000, which is the residual value. Okay. Journal entry, debit depreciation expense, credit accumulated depreciation. How is this going to be shown up on your statement? On the income statement, you will have an item which is called depreciation. So if we are in year 4, look at the depreciation for year 4. Equal, and go to year 4. This is year 4, and depreciation $8,000. Okay, this is what will be in your income statement. An extract of your income statement showing the item in question. An extract of your income statement showing the item in question. And now an extract of your statement of financial position, balance sheet. How is it going to show up? So in your assets, as part of your new non-current asset, the PPE itself, you put the cost, the original cost. Cost is $106,000 minus the accumulated depreciation. In year 4, at the end of year 4, this is the accumulated depreciation. After year 1, 2, 3, 4, at that time you have been accumulating depreciation until you reach $32,000. So minus $32,000, then the net amount is the net carrying value is cost minus the accumulated depreciation. This is what will be shown on your balance sheet at that year 4. If what is this? Now, if the unit of production is used, unit of production. So then for year 1, so they say the total useful life unit produced is $200,000, which means a depreciation per unit of 52 cents. With every unit produced, you lose 52 cents as a depreciation. If you have consumed 20,000 or produced 20,000 units year one, so it would be 20,000 times 52 cents. You get the total amount of your depreciation using the unit of production. So for year one, it would be depreciation expense 20,000 units multiplied by 52 cents per unit. Accumulated depreciation is the same. Carrying amount is 106 minus the accumulated depreciation. Year two, they say the actual number of units produced in year two was 16,000 multiplied by 52 cents, which is the depreciation per unit. And then you get the dollar amount of your depreciation. Calculate, update your accumulated, this plus this. Your carrying value will always be the cost minus the accumulated today. And you keep going, and again, you will end with the residual value if you keep going. Finally, the double declining. Now, if we use the double declining method, so first year, how do we calculate the first double decline first year? So what is the carrying value, the opening carrying value? The very first carrying value is what? Is the cost itself. Because the carrying value is cost minus accumulated. We still have no accumulated depreciation at all to start, so the carrying value at the beginning is the cost itself, $106,000. Now, depreciation for first year would be the carrying value, which is the cost for the first year, multiplied by the double decline rate. Is it here? Do I have it here? I don't have it directly. Let us calculate it. So it is 13 years. So instead of you divide by 13 years, that is the equivalent straight line, double of it. You divide by 2, divided by 13. Okay? So depreciation for the first year would be 160,000 multiplied by 2 divided by the useful life 13. And if you can of course make determine also a percentage, a double decline in terms of in percentage. So accumulated depreciation is this. Carrying value is the cost minus this. And then year two. So that carrying value, the $89,000 multiplied by 2 divided by the same 13. Now accumulated depreciation, this plus this. The new carrying value, 106 minus the accumulated depreciation. And that will be used to calculate year 3, $75,000 multiplied by 2 divided by 13. Accumulated 30 plus 11. Carrying value, 106 cost minus the accumulated. And you keep doing this until now. You keep doing this and you keep watching what? Your residual value. How much is the residual value? Residual value is $2,000. Okay? Your carrying value will decrease progressively. As long as it is higher than $2,000, you have to continue doing the same calculation. Previous carrying value multiplied by the rate and accumulate depreciation, update your carrying value, decrease. As I decrease, I have to keep watching that $2,000 residual value. This decrease should automatically, if you continue, it will never end. You will never reach zero, okay? You will be closer to zero, but never reach zero. But you have to stop the process. The cap is the residual value, okay? As you can see, 38, 23, 12, 7, decrease, until I should not keep it, make it, look at the last. So as I discussed with your colleague in an exam, do I really need to make that first attempt rejected and then the correct answer? I said, I told him that wave presentation first attempt rejection, it is for pedagogical purpose, means to explain, but you're not obliged to do it. Because look at this, for example, here. At some point, year 12, I think, I reached this carrying value, 2,270. I know I'm very close. I know I should not get to 2,000. Maybe I can guess. I don't have to make a first calculation and stop it. So just if you apply the same rule, this, let's try it. If you do in your draft without making a full line and call it rejected and do it again. In your draft, you make an attempt on the draft. If I do this, multiplied by 2 divided by 13, I will have $300, 350 almost. 350 if I add it to, I know that I should not exceed 104,000. If I add 350 to 103,726, I know that I will exceed 104. So clearly 350 would be rejected. So then I force this amount. I put this amount as it should be this in order to reach 2,000 as a carrying value, and then ask myself what would be the amount needed to reach the $104,000. So far I have accumulated 103,726. If I add this, I will exceed the maximum, the top. Then I should not add this, I should add an X amount, whatever is needed to bring the accumulated depreciation from 103,726 to 104,000. And that amount is just the difference between this and this, $273, which means we do not calculate it the same way as the rest. We change the rule, and then we ask ourselves what would be the X amount needed to achieve the maximum. What is the maximum? Cost minus residual value. Cost minus residual value, that is the maximum of accumulated depreciation you can accumulate. That's it. This being said, we have covered all the aspects needed for you. So please continue working on your assignment and connect, and also these Excel practice. So this time your final exam will be a mixture of means problems taken as is from Connect plus problems from the Excel. So familiarize yourself with both, and it should be okay. You were very successful on the midterm, and there's no reason for you not to be also